Okay, so very good morning to you. The topic that we shall start today is about the risk management. Of course, it's the financial risk management. The principal idea of the financial risk management is coming from the assignment which you have done before, which you're supposed to do. That is the financial ratio analysis. Because in the financial ratio analysis, you identify some of the risk which the company is either going through actually in real life or may go through in the future. So as a proactive measure, you are doing the financial risk management. Okay, so there is a linkage between accounting and finance. That in accounting we first spotlight the risk, but in the finance we take some actions. Okay, if I can quickly move this. So this is why the topic 3 that we shall discuss today is about the corporate risk management, but we shall be using the currency forwards to analyze it. We did one example, do you remember? We did last week one example. Anybody remembers that? No? Sorry? Say again? Exchange rate risk. Yeah, so we started some hedging yesterday. And by the way, just in case you don't know, or you have not seen for a long time, let me show you where it is. Access this, this link, study material in Moodle, and here you'll find all the lecture recordings available. And I think the lecture that we had last week, when was it? Yeah, the risk management. So that is also available here. I remember last week when I met, I gave you a brief introduction of academic track and then also introduction to risk management. And it was on 3rd of April, I guess, yeah. And then we didn't have a lecture on 10th, did we? No, because there was a break, yeah. So yeah, so everything is everything is recorded, yeah. Right. Yeah, so these are the objective of this topic, that we shall be studying the different financial risk management techniques. Basically, forwards will be our main, the main method we will be focusing on. Some rationale behind these derivatives, some examples. You'll see it soon. The major risk which you might see in accounting task 1, which you will be doing that, either the costs are rising or the revenues are falling, the debts are rising, the finance costs are increasing, and the cash cycle is increasing. These are the very normal, usual problems which the companies can experience. The costs are rising, of course, these days, the costs are rising. And I think we discussed about rising cost one day about this stagflation. You remember? We had discussion about stagflation. That inflation, when we have the evils, when we have the worst part of both evils, when we have inflation as well as recession at the same time. Inflation, because the prices are increasing, and recession because the unemployment is rising as well. So that is a stagflation. So one major reason, I'm just speculating that when you do your task 1, assignment 1, you might come across these conclusions. I'm just hypothecating that you will say, oh, the cost is rising, the revenue is falling, the debt is increasing, and the debt servicing is also increasing. Debt servicing means when you pay the high interest. So the debt servicing could become expensive. The cash cycle can increase, which means that you have to wait for a longer period. So you have to make a lot of money in the business. You have to keep money stuck, because from the point the raw material comes in the factory, it's processed, it's sold, and the money is recovered from the customers, that cycle could be very long, okay? Which means that your company would be dry of any cash for a very long time. So you have to manage those dry days, those cashless days, okay? So all these things could be the potential problems which you might come across in your assignment. And also, these risks could be explained in terms of foreign transactions, like the rising cost, okay? Your strategic raw material, which you purchase, the cost has gone up. You used to buy some very important raw material from Australia for the manufacturing, but now the price have gone up. Falling revenue, most of the output used to go to Canada, and now the Canadian companies don't want to buy much, or the Canadian dollar has become cheaper vis-a-vis, euro. So things like these things can go, and they can make your cash flows disturbed. Rising debt, you have borrowed a lot of money from Britain. You were thinking that the pound, the interest rate in Britain is less. So you thought that, okay, why to borrow from a Finnish bank? Let's borrow from a British bank, Royal Bank of Scotland, for example, or Barclay, or whichever bank. That was true. That was good decision. But what happened now? That the pound is appreciating against euro. So even though your interest rate is very low, but when you are transferring the interest payments by converting euros to pound, you have to pay a lot of money in euros. So that thing, so look at the tragedy. You are thinking that, you know what, in Finland, the interest rate is 3%. In Britain, the interest rate is 2%. Let's borrow from some British banks. And you were successful in getting the loan as well. Good decision. But what turned bad for you is that now when you want to pay them back, you have to pay them in pounds. So you have to convert the euros to pounds. But the problem is that now pounds have become very expensive. Pounds are appreciating against euro. So whatever saving you have made in the form of lower interest rate has been cancelled, or rather you have to pay over by converting euros to pounds. So it's like one step forward, two steps backwards. These type of things do happen in the financial world. You think that you're a very wise person, you have taken very rational decision, but after some time, you might have to burn the fingers because your decision, so-called wise decision, could have backfired. If not the same way, but in a different way. So you have to be ready for all these type of contingencies and all type of risk, and we have to manage them so that we, okay. Your job is not only to diagnose the problem, but also find the solution, okay? So in this task, in this assignment, in this topic, we should try to find the solutions to the problem, okay? Yeah, and these days, not only these days, but I think for a long time, the companies are exposed to these type of risk in the foreign exchange markets. You earn revenue in one currency, but the costs are paid in other. You see? You get my point? So you are earning all the revenue in Finland in euro, but the major cost component is you are paying in Chinese currency, because all the manufacturing, all your factories manufacturing is taking place in China, for example. Time difference between the dates. So imagine you are a Finnish company and all the inputs largely come from China, and then all the output, when you invoice them from Finland, the bulk of your output goes to Canada. So look at the time difference and the different currency in the time zone you are in, okay? And that whole thing can take months. I mean, it could be possible that your supplier in China is giving you 3 months time to pay him or her, but your Canadian customer will not pay you before 9 months. So look at the time, the waiting period. The cash cycle is not only longer, but the cash cycle is also uncertain. Try to visualize a situation. If the same example happens in Finland, your supplier is in China, is in Finland, your supplier give you 3 months credit, and your customers are also in Finland, and you give them 9 months credit. Look at the situation. And then in this new example, your supplier is in China and your major customer is in Canada. So not only you have to face this long, dry spell of cashlessness, this is a new word, but at the same time, you have to continue face the exchange rate fluctuation. You're every day, you're scared. Oh my gosh, what's happening to the Chinese currency? It's appreciating. Oh, you have to pay more money when you pay them. And then you find that, you know what, the Canadian dollar is going down against euro. Oh, it's double whammy. You are inviting problem from both sides. So would you like to live in this situation? Of course not. The European firms manufacturing in Europe. So the same example, which I said. So all these type of things make the global trade far more complex. Look, the thing is, the good news is that the foreign trade is very large now. The foreign transactions, volume, value is so big. I would show you maybe one data, maybe it's at the end of this file. You will see that on everyday basis, there is about $8 trillion worth foreign exchange transactions every day. The Forex market is so big that it's about $8 trillion transactions on daily basis. And if we say that there are 250 working days in a year, so you can multiply 8 trillion by 250 and look what figure you get. Is anything beyond trillion, zillions, or whatever you call it? So that could make a very big amount of money. Yeah. Yeah. So I want to show you with the real data that the exchange rate fluctuations could be very dangerous. Here I downloaded this data. Is it visible through Zoom, sir?
Yes.
Yes, sir.
Okay, good. So can I give this rights to conduct? Oh, you have it. Good. So I'm not taking care of this. So you look up here. Good, good. So you can see here that I downloaded this data from Yahoo Finance last year. So this was the price of €1 in dollars terms, right? You see my point? So this is the price of €1. So price of €1, the exchange rate on February 13 was €1 equal to dollar 1.1365, and on February 14 it was 1.1311. Make sense? So the price is in, say again, the price is in dollars, American dollars. So this is the price of €1 shown in American dollars. Tell me one thing, I want to ask you, which country you would be living in? Will you be in Eurozone or will you be in the USA if the price is shown in American dollars? When you go to Prisma or Lidl, do you pay dollars or euro when you buy some chocolates? So how come the price would be in dollars and you are in Eurozone? You see my point? This is the price in dollars. Do we use dollars in US club? No. Where do you pay? Where you buy and sell in dollars? Which country? In the United States of America. It means this is the price of €1, but shown in dollars. So this is the exchange rate of €1. So on February 13, let's say on February 14, I can say that on February 14, the exchange rate was, let me put the comment here. So this was basically the price of €1. can put a new comment, okay? Right. So the price of €1 was equal to American dollars 1.1311. Can you see that? So the price of €1 was equal to American dollars 1.1311. And this is the exchange rate quote in the US market. If it has to be a quote in the European market, then on the left side, it should be $1 equal to so many units of euro. Because so many units of euro means how many euros do you pay to buy $1 American? Well, we use the euros to make a payment only in the Eurozone. So try to learn a lesson that whenever you write the exchange rate, the figure one exactly on the left side should always be of foreign currency. And on the right side, in certain number of units, that currency should be what you are making for transaction. The problem is that if you write opposite, imagine you are in Finland and you write the exchange rate of American dollar equal to €1 is equal to so many US dollars. And where are you? You are in Eurozone. Guess what? You would make an unpardonable mistake. What you think is coming in is actually going out. So you would be treating losses as profits and the profits as losses. So never do it. One lesson you learn whenever, and this is I'm giving you a big statement, you underline it, whatever you do, that depends on you. Always on the left side of the sign of is equal to with 1 unit should be the foreign currency. And then on the right hand side, like for example, here you see that €1 on the left hand side, right? Can you see that? Equal to certain number of American dollars. This is a right way of writing the exchange rate. If you are paying and selling and buying, if you're making payments in American dollars. But if it happens that you write this type of exchange rate and you are making payments in euro, this would be a massive mistake. Never do it. Okay? So always make sure that on the right-hand side of the equation, there should be number of units in which you are making the payments or receiving the money, whatever way. So the unit, the currency of transaction should always be on the right-hand side of the equation with certain number of units. And on the left side, which is always 1 unit, should be the foreign currency, which you are, comparing with. Is it a lesson forever? It must be, because otherwise you will be doing a very big mistake, right? And this problem is very common. You know where? This problem is very common in Britain. Because in Britain, technically, when you are working in some British company based in London, in Birmingham, wherever, on the right-hand side, by this logic, there should be the units of pound. But the problem is that even in the Financial Times, even in the financial media in Britain, they always write as £1 equal to a certain number of dollars, certain number of euros, certain number of yen, which is actually conceptually wrong and confusing. So remember that the domestic currency which you are using should always be on the right-hand side, right? This lesson should be learned forever. Okay. Though I shared this spreadsheet already in Moodle, but I would send the new version with the comments, okay? So the exchange rate fluctuation, you can see that when the market opens on February 14, this was the rate for one euro in America, in the USA. The price went as high as 1.369. The price during the day went as low as 1.1300. And here you can see that this is something which I have done is the change of the movement of exchange rate. And you can see that in comparison to February 13, euro has become cheaper on February 14th, because it used to be 1.1365, then it became 1.1311. So look at the last 4 digits on the decimal points, it has lost. So what happened here? And the sign becomes minus. Minus means, minus means that the euro on February 14 depreciated equal to 0.48% in comparison to February 13. But when you see the February 13, you see that on February 13, the price went up, the exchange rate, the euro became more expensive or more appreciated. We don't, we don't say expensive, cheaper. We rather use this phrase for if it goes expensive, we say appreciated or appreciation. And if it becomes cheaper, we say depreciation or depreciated, right? So you can see that on Feb 13, euro appreciated. On Feb 14, euro depreciated against American dollar, right? Does it make sense? Yeah. So that is why this exchange rate movement could be very lethal, could be very dangerous. You see my point? Now you can ask me one question. That Shab, if a company is a small, let's say some garment making company in Uvascula, neither they import something nor they export something, how come this exchange rate will affect them? Is it possible that you remain unaffected by the exchange rate movements if you neither import anything or export anything? Can you remain immune to the exchange rate movements if you have no business dealings abroad? Let's put it this way. It's my question to you. If you say yes, no, then then you back up your answer with some reasoning. Yeah, Seher, would you please? Any ideas? Any thoughts? Yeah. Yes. When the inflation happens, then inflation has the first side effect of inflation is that your currency becomes weaker in comparison to the other well-known currencies. And when your currency becomes cheaper or depreciate, then your import becomes expensive. And when your imports become expensive, what happens? The prices in general, look, even if you're a Uvascula-based company, neither importing nor exporting, but you still have a car and you need the gasoline. If there's more inflation in EU in comparison to some other, let's say the crude oil is coming from Canada, let's assume, okay? If there is inflation in EU, then the euro would weaken against Canadian dollar. And even if you're not importing or exporting anything, your gasoline bill will go up. And that would add to your cost. And I go a step forward, what you have said, that imagine you have a small shop where you sell the clothes, okay? All the supply comes from Finland and all the market is in Finland. But guess what happens? The pound start becoming cheaper against euro. It means that the Finnish customer who buy clothes from you, they start considering buying clothes from Britain. And they don't have to go to Britain to buy them. They know that, this shop, the big store, they are selling those very nice branded clothes cheaper, and they are made in Britain. And because the pound is cheaper against euro, yeah, then what happens? Buying, instead of buying from you, local clothes, they will go and buy these imported clothes. So what happened? You are thinking that I'm immune, I'm safe. But guess what happened? A big chunk of your market start buying those imported goods. Exactly. So you start losing. On the one hand, in one example, which you mentioned, that when the inflation comes, the currency becomes weak. And if your inputs are coming from that country, your input cost will go up. And on the other hand, if some other currency depreciates against your currency, guess what happens? You start losing your market share. So it can be a sandwich effect that on the one hand, your import bill can go up, and on the other hand, your export revenue can also shrink because of this thing. Yeah. So yes, these are the things which could cause you the trouble. Okay, coming back to this other file I will discuss with you later on. The forward contract is the one way to mitigate, not to remove this risk, but to minimize the risk. And in the currency forward contract, what happens is that when you are having this situation, that you can face this risk of fluctuation because you make payment after some time, or you receive payment after some time, and you want some certainty. And what you do then, usually you go to the bank, and there is an over-the-counter contract. We also say that the forwards are, by the way, a disclaimer, whenever I say the word forwards, I mean here the currency forwards, okay? So what you do that, there's an over-the-counter type of dealing. On the one side, the bank manager is sitting, and on the other side you are, and you explain your situation that, you know what, we have bought some goods from Australia. We have to make the payment in 6 months' time, okay? We have to pay in Australian dollar. We are afraid of Australian dollar appreciating, okay? Could you give some quote to us right now that we lock in the contract? Look at the word lock in, yeah? Lock in means we fix the exchange rate and we make a deal right now that we know for sure that today, even though the payment will take place in 6 months' time, we know that how much money we have to pay on, let's say, October 10th, 2023. So this locking in is the main purpose of the currency forward contract. And what do we do here? The contract is about specified currency. So if it is Australian dollar, call it Australian dollars. You can't use it for the Canadian payment. No, it has to be in Australian dollar. And then you also decide the specified amount of hedging, how much amount you need. Okay, if you have to make a payment of, let's say, 3 million Australian dollars, you say 3 million. Okay, the contract amount is 3 million. Specified rate of exchange, that could be negotiable, because remember, you are not going to a stock exchange to get the forward contract. You are negotiating with the bank manager, okay? You can negotiate. Sometimes you can say that, you know what, I don't like this quote. Can you make it a bit lower? Can you make it a bit cheaper? Don't we? Yeah. When you buy a house and you know that how much interest rate you need to pay, is any interest rate market where you go and buy the loan contract, or do you approach individual banks and sometimes even negotiate? When I bought my, when we had this our house, I negotiated with at least 4 banks in Finland. I fixed the meeting, I negotiated with them. And I was doing this way, that I would take the copy of one bank's offer when I go to the next bank, and I would, if they're offering me higher, if they're going to charge me the higher rate of interest, I would show them that, you look, I just have to walk across the road and this contract is available with me. Oh, let me talk to my manager. Oh, yes, we can also give it discount. So this is called over-the-counter negotiation, OTC contract. It's not that you go to some stock exchange and the price is fixed and you can't negotiate. No, in forward, you can negotiate. Why? Because there's a direct dealing between you and the bank across the table. So that is why a lot of negotiations are possible. So there is a specified rate of exchange, the exchange rate, which you determine. And then very importantly, there is a specified time period. Okay, if your contract is over in 6 months, 6 months, that's it. That contract is not valid for 7th month. So there are 4 specificities when it comes to risk management, especially through hedging, especially through the forwards: specified currency, specified amount, specified rate of exchange, specified time period. If one of them is missing, the contract is not valid, the contract is not binding. And another thing, in forwards, lock-in. With lock-in means neither the bank would run away from fulfilling its commitment, nor you can cancel the contract. You see my point? The beauty of the forward contract is that it's so easy to negotiate, but the bad thing of this contract is that once you sign, it becomes binding. No power on this planet can change this contract, right? It could be possible. Look, I'm making it more cynical. It could be possible that you are a Finnish company. You are going to buy something from Australia and you will pay them 3 million Australian dollars. And today is 17th of April, right? You went to the bank, you signed the contract, the deal is done. On 20th of April, you cancel the contract with the Australian buyer. You see my point? You say that, you know what, we're not going to buy anything from Australia. You cancel the contract. And then you realize, why we have this, why do we need Australian dollars from Nordea Bank now when we don't have to pay? And then you go to the bank and say, you know what, Mr. or Miss Manager, we signed a contract 3 days ago, the forward contract. Can we cancel it? Because we don't need to pay anything to Australia. The bank would give you a very clear no. No, that's your problem. You are a buyer. You don't have anything to buy from Australia. That's your problem now. Look, on 10th of October, whatever is the date, I don't care who is saying this thing, the bank manager is saying, and I'm a little bit dramatizing it. I don't care. You need Australian dollar, or you need or you don't need on 10th of October. We have signed the contract. The papers are with me. The copy is with you. We both have signed. The contract is binding now. On 10th of October, I don't care. You have to take 3 million Australian dollars from me, sell them in the market, do whatever you want, but you have to take from me. And you have to pay me certain euros at the pre-decided rate of exchange and take $3 million from me. The contract is binding. If both parties mean either bank or the customer, if they try to cancel the contract, there would be serious legal repercussions. You see my point? This is like a one-way traffic type of contract. This is something, the main limitation of the forward contract is that it can be rigid. You know, the rigidity is the main problem of this contract. Yeah. But the probability is very low, you know, that you can cancel the contract. So this is how it goes. So that is why I use the phrase lock-in, that this is locked-in contract, nothing can change it. It's locked in. There are some other ways to do the hedging. We will discuss them as well. That they are more flexible. They are more flexible. But this is old-fashioned contract, still very popular among people because it's so easy. See, why it's so easy? Because in the big market, nobody knows you. But in the city, in a small city where you have a bank account, because with a bank, you have a very personalized type of relation in the sense, because you have a bank account there, you've been dealing with them, okay? So they will treat you in a nicer way, and you can also negotiate the rate of interest, the rate of exchange, and so on and so forth. So that is why there's an inherent flexibility in this contract. But there's a legal thing that you can't cancel it.
Yeah, hello.
Hello?
Yeah, can we say it's the same thing as a fixed rate exchange rate?
Yeah, it's a rate. The rate of exchange is fixed.
Okay, you can call it fixed exchange rate.
Sorry, say again?
I said, can we call it fixed exchange rate?
Yeah, you can call it fixed. Yeah, yeah. The rate of exchange is fixed. The rate of exchange is fixed, even though the fixed exchange rate is a different philosophy. But yes, but in this example, it will not be bad to say, it will not be wrong to say that the rate of exchange is fixed already. Yeah. All right. So, for example, we can discuss this. A Finnish firm is going to purchase some products from the US multinational subsidiary based in China. The goods will be sold in Finland. You make a payment of 25 million US dollars, and the payment is made after 45 days. So what type of risk you are exposed to? If you're a Finnish company, what risk are you exposed to? Well, the biggest risk you are exposed to is that the US dollar's appreciation against euro in the next 45 days could be a problem. Because you have to make payment. The best scenario is that all the currencies you import in, they depreciate. You see my point? Or did I say wrong? No. Yeah. So yes. So all the countries, yeah. So if the Canadian dollar is something you pay in and it becomes cheaper, it's good for you. On the other hand, the countries in which you export, if they start appreciating, then it's good for you. So that way. Right. I want to show you one thing, which, remember, when I started this example, there were some confusions. Were there? Were there some confusions? Have a look at this now. So this is the price. Oh, sorry. This was the quote in dollars. And look at the quote. This is the quote in, sorry, just a sec. This is the quote in euros. Yeah. So this is the quote in euros. So where are you now when you are considering this? In the Eurozone. And guess what? The data which I got was in this American dollars. Look at the top. What do you call it? This window where you see this rate of exchange, right? 1.1365. Yeah. You see my point? And now look at this. This is a trick. So basically, if you know the rate of exchange of €1 in American dollars, you can also find the rate of exchange of $1 American in euros. And guess what I did? Guess what I did? I simply put it other way around. So if I say that €1 is equal to $2, $2 American, then $1 American would be equal to 1 divided by 2, 0.5 euro. So that's what I've done here. But it's very important that you are able to, first of all, use this method if the rate of exchange is in a different format. So these things are very important for you to learn as a student of finance, okay? All right. And guess what? On February 14, euro depreciated. Yeah, and look here. On February 14, dollar appreciated by the same amount. Can you see it? When it was in American dollars, it was minus 0.48. But now the same number is, the numbers are the same, but the signs are reversing. So the day euro was appreciating is the day when dollar is depreciating. Can you see that? The numbers are same, but the signs are opposite. So that is why it's very important for you to learn that in case the exchange rate is not given in the desired format, you should have enough skill and knowledge to convert it in the unit in which, yeah. Sorry?
I don't think they can change actually the same amount because they have the different dollars. So if the dollar changed for 0.848, that means the euro will change for a different, because the actual value is not the same. And I think the percentage, can you scroll down a bit? I think the percentage should be 0. I don't know, maybe. I don't know. I was just concerned. Because, for example, let's say that the dollar was, for example, 100 something.
If you change the rate of exchange, then it will be depreciating in the other measurement. Okay. Right. The forward contracts are generally high value contract. Okay. One thing you need to learn is that the forward contracts could be high value. So if, for example, the next summer you are planning to go to holidays to Britain, and you think that, hey, Shab was discussing about it, there's a risk that pound can depreciate, and our whole, Sahar, could you? And if you think that your family is going to Britain and the whole trip will cost you £3,000, travel, staying in the hotel, why don't we go to the bank and we buy the forwards? No, you can't do it. They are high value contracts. So they have to be a couple of thousands of dollars, So the number has to be really big enough to be transacted. For the retail type of things, for the low value contracts, you cannot use the forward contract. It has to be the high value contract. So sometimes for the small firms and for the small consumers, this remains like a white elephant. You can't get it. We take the decimal point at the 4th level. Like, for example, a euro or dollar or any currency in the world have 100 units, right? So you can start from 1 cent or 1 pence, whatever. So 100 makes it $1 or 1 euro, right? So it means that ideally the decimal point should be 2 decimal points, right? But because we are watching the movement of exchange rate at very minute level. Therefore, as a rule of thumb, not a theory, but as a practice, we always take the exchange rates to the minimum 4 decimal points. You can see that this is the original data, right? And how many decimal places we have? 4. But here, this is not the original data. You know why? Because I just changed the formula, 1 divided by this, right? But normally, the exchange rates are given, the codes are given to the 4 decimal points, okay? Because you're not going to buy. Now you can ask me, Shab, what does it mean basically? That 1 euro is equal to $1.1311. Okay, it means that if I give $1 to the bank, they should give me, if I give 1 euro to the bank, they should give me how many American dollars? 1. How can you pay somebody 1.1311? It is because you are not going to buy one unit, you are going to buy some hundreds of thousands. So when you multiply with the 4-digit decimal point thing, it makes sense. You see my point? If it is 1.1311, and if you sell 10 euros, you will get 11.311, still not possible. So minimum 100, minimum 100 euros should be, but at least not 100, it's a couple of thousand of, units which are transferred. All right. We take a short break now in 5 minutes time. And when we come back, I want to give you an example. So we start another story. There's one Belgian company, which is the importer. And they're going to buy something from Canada. So the Canadian company is the exporter here. And the deal between the Belgian importer and the Canadian exporter is that the importer would make a payment in Canadian dollars. So the payment comes to be, I think it's 3 million Canadian dollars, right? And let's imagine that the payment would be made, in 6 months, whatever, but not now. It's not like pay as you go thing that you buy goods for 3 million Canadian dollars and then you go to the till point and you swipe your card. It doesn't go like this. So it's a time gap between the transaction and the payment. Actually, this is the last year example. So I think when I took this example, that was 14th of March, right? And the payment is due on, let's say, 39th of September. You can ignore the year, or I can change it later on when I send you the new version of the file. In the spot rate, in the spot market, you know what is spot market? If you want to buy right now, if you want to make a payment right now, you buy something on 14th of March, and you want to make the payment on 14th of March. So the prevailing, the current exchange rate is called, look at the phrase, at the spot. What do you mean when you say at the spot? What does it mean, basically? Right now. So the spot rate, at the spot rate is that 1 Canadian dollar is in Europe in 75 cents or 0.75 euro. May I ask you one thing? If you are going to make a payment to a Canadian company, and first you pay euros, and then you buy the Canadian dollars, and then you transfer the money to Canada, is it the right way of writing the exchange rate if you are a European company, or is it a wrong way of writing? 1 CAD is equal to 0.75 euro. Right way or wrong way? Yeah. Okay, let me show you one more thing. See the comment. Does it make sense? So 1 euro is equal to dollar so. This is the exchange rate quoted in the US market. In the US market, which is the alien, which is the foreign currency, euro or dollar? In the US market. If you're living in, if imagine that right now you are in New York, what is your domestic currency? Dollar. So it means that the foreign currency is euro, right? So foreign currency is always with signified with 1 unit on the left-hand side. So 1 euro equal to certain units of domestic currency. You see my point? So the domestic currency units always come on the right-hand side. And now you compare this example. You are a Belgium-based importer. You're going to make payment to Canada, and the payment will go in the Canadian dollars, right? It means that you have to buy Canadian dollars and you have to make payment in euros. So therefore, this exchange rate, do you still hold the same opinion? 1 Canadian dollar equal to euro 0.75. Is it fine? Because it's on the right-hand side of the equation, and the 1 unit is always given to, denoted to the foreign currency. And in this case, the foreign currency is Canadian dollar, right? So you are making all transaction in euro, therefore the euro thing is on the right-hand side of the equation. So it's right. Yeah, okay. Now, see, if you have to make a payment right now, on the spot, you will simply go to the bank, you will pay them 2.25 million euros and get $3 million. As simple as that. But that will happen in the spot market. Why will you not do it? First of all, the countries you want to avail, we have studied in the ratio analysis that you want to get the maximum credit period from your supplier. So you always delay the payment to your suppliers. It's good for you because you get the credit period. So always speed up the receipts and delay the payments. This may sound a little bit unethical or immoral, but this is the practice companies want to do it. You want to give less credit to your customer, but you want to get more credit period from your suppliers so that you don't have to lock cash unnecessarily in the market. Because if you have to make the payment right now, you are not utilizing the credit period, basically. Do we all agree with this? All right. But what you do now is the due date is this, okay, total payments. Yeah. What you do is that this is out of question. However, I wrote the reasoning. However, in the foreign trade, companies do not pay cash at the time of transaction. Rather, payments are made later. Yeah. So the biggest fear for you is that you don't want to make the payment right now. It's a fact. But if the euro depreciate or the Canadian dollar appreciate, and at some stage it happened that the Canadian dollar 1 is equal to euro 1. So instead of 75 cents, it becomes full euro. Then your payments will go, there would be how much? 33% rise in your payments. If you keep your position unhedged, unprotected, and we also use this weird word, naked position. So covering means we cover the risk, and naked position means that we keep our position unprotected so that the market movements can adversely affect us. Okay, so these are different phrases that we use. So what you need to do is, on 14th of March, you approach a bank. And let's say you, because you're a Belgian company, let's say you approach BNP Paribas, and you say that, Mr. or Miss Bank Manager, we need a specified amount of 3 million of a specified currency called Canadian dollars. And we need to make a payment in 6 months' time. The exact due date is 13th of September. And then one more specified is left. That specified come from the negotiation. And the deal is that for each Canadian dollar, the Belgian company would pay 83 cents, European cents, right? So the rate of exchange is pre-logged, is logged. So now when four specifications are settled, the contract is signed, the contract becomes lock-in now. Now on 14th of March, you know that you will be making a payment. You will give the bank 2.49 million euros, not now, when? In the month of September. And then the bank would supply you with 3 million Canadian dollars, and the payment would be made. Simple. Lock in. Yeah. So you pay 2.49 million euros, and in turn, you get 3 million Canadian dollars. And this contract is signed right now. For the next 6 months, you don't have to worry. Things are settled down. And look at the word lock-in contract. There's no secondary market. Secondary market is that, imagine I buy this contract from Nordea Bank. Yeah. Tomorrow, my contract with this Canadian company is canceled. I can simply go and sell this contract to somebody else who needs Canadian dollars. You see my point? Like, it's like you buy a jacket and after 2 days, you realize that I think I don't need it. What you do, you simply go and return it. Why? Because there is a secondary market, or at least you can sell in some second-hand shop, right? Here, that thing is absolutely out of question. The contract is between you and the bank, and it remains whatever happens. Maybe in the rarest of rare cases, if there is an absolute crashing of the markets, maybe then things can go that you can cancel. But in the normal business as usual type of situations, nobody can change it. No, that's what I'm saying. That's why I'm saying that you can't do it. I think I didn't explain it well. You cannot do it. In the secondary markets, there's a primary market and there is a secondary market.
Exactly. In the forward contract, okay, I canceled my contract with Australia, but I'm going to receive that money from the bank. It's something like bounding, so not cancel it. So I can negotiate with some other company and like store those amount of Canadian dollars by myself.
Look, in a parallel manner, you can do whatever you want. But the contract which you have signed with Nordea, you can't sell it to somebody else. Look, when we buy a house, we have the house papers. And guess what happens later on? Now we want to sell the house. We can simply pass those papers to somebody else, can we? You can't do this thing in this case. So on the due date, you have to take 3 million Canadian dollars. You have to pay 2.4 million euros. Now, because you don't need any now you can sell those 3 millions in open market, or you can keep in the bank account, maybe you need in the future, or you can do whatever you want, but not through the contract between you and Nordea Bank. You can do whatever you want with that money, but you can't change the contract. You can't ask Nordea Bank, hey, you are having many other customers also. Can you find somebody who needs this Canadian dollars? They would say, no, it's not my problem. You do whatever you want. Why should I bother? Yeah. Play with this. Take some pictures of Canadian dollars and show on Instagram.
This conference based on personality or person or company. The other people can involve and can be involved and can be into the contract.
Can be. Cannot be. Yeah, yeah, yes, exactly. Yeah, you're right. Yes. So why you do it? Why are you doing it? Can I ask you one thing? When you think that this having this contract was not necessary, I mean, look, the spot rate is 75 cents for 1 Canadian dollar, right? The spot rate is 75 cents for 1 Canadian dollar, right? And the forward rate, and remember, this is on which date? 13th of September, 14th of March. And this is the forward rate you fix with the bank. And this also you do in 14th of March. What if you have not covered your position and you remain, at the mercy of the financial markets? And on 13th of September, the rate of exchange is not 95, but let's say 40 cents or 30 cents. Or, the Canadian dollar become very cheap. Was it not a good idea by not taking the insurance? Did you understand my question? It's a purely risk because you never know it. You never know it. Yeah. As a matter of fact, I want to give you a very important hint now. Do we agree that this spot rate, please focus on this spot rate and this forward rate are on the same date? And the date is 14th of March. You see my point? Whenever you see the forward rate higher than the spot rate, get some idea that in the future, this country's currency is going to show an upward trend. So the forward rate is a glimpse of the future day spot rate. You see, you can use it as a hint, as a kind of feeling that, you know what, if the forward rate is going to rise, is bigger than the spot rate for this time period. So there's a highly likelihood that this country's currency is going to rise. Yeah. It can go otherwise. There's always a risk. That is always, it's like every time I give this example that you buy, if car insurance was not legal, it was optional, and you are the best driver in the world, you know all the tricks and everything, you can drive on the icy tracks, whatever, and you think that, hey, I'm driving so well, I don't need the insurance. And then you find that, why do I pay insurance premium every year? Okay, this year I decide not to have the car insurance. Huh? How about others? Yes. How about others? Yeah. What can we do then? It could be a problem. Yeah. So therefore, yeah, some risk element, and even though you're doing risk management, but still some element of how to say that uncertainty zone would remain. Yeah. So please remember one thing, that when you are an importer, you are afraid of that the foreign currency would appreciate. Yeah. So this is your biggest fright, and this is why you have this contract. On the other hand, when you are a seller or when you are an exporter, now you are afraid that the foreign currency can depreciate and kill your cash flows. Okay? Especially if the customer abroad decides to pay you not in your currency, but his or her domestic currency. So the same thing happens here. This time you're a Belgian exporter, and this time the Canadian company is the importer. And again, you make a sale, you make an export of 3 million Canadian dollars. So the company in Canada, who is your buyer, who decides or negotiate, you know what, we will not pay you in euros, we'll pay you in Canadian dollars. And again, the spot rate is this. If the company fortunately pays you right now for 3 million Canadian dollars, you would receive 2.25 million euros. Things would have been, life would have been much easy, but this Canadian company want to get the credit from you. Okay, why should they pay you when it's possible not to pay right now? And then you are afraid, this time you're afraid that the Canadian dollar can become cheaper. And when you get the money on 13th of September, it's pittance, it's peanuts. You get nothing. So now your fright is opposite. See, when you're a buyer or a seller, you think differently, right? And imagine, yeah. So now what you do? Again, you go to the bank and you say, Mr. or Miss Bank Manager, we need to sell. Look, you're buying a contract from the bank to sell Canadian dollars. You see my point? This time you deal with the bank that I want to sell Canadian dollars to you. So this time the bank is buying from you and you are selling. In the previous example, you were going to buy Canadian dollar from the bank. This time the contract is that you have to provide the bank with 3 million Canadian dollars. Your contract remains or doesn't remain is a different thing. You have to provide bank 3 million Canadian dollars on the due date. Specified currency, Canadian dollar, specified amount, 3 million, specified time, 6 months, and the specified rate of exchange is this. And at this rate, now you know that, now you know for sure that, and this decision is made right now. On 14th of March, you know that on 13th of September, you have to give 3 million Canadian dollars to the bank, and bank would give you 2.49 million euros. If your contract with the Canadian company is cancelled, the bank doesn't care about it. You have to provide 3 million Canadian dollars, and the bank will give you 2.49. It's a lock-in contract. No party can back out. Okay, there can be serious repercussions if any of them try to. And it's not a secondary market. So even if your contract is cancelled, you can't sell your contract to somebody else. It's between you and the bank. Nothing can happen. Okay. And look, I'm just portraying a very bad picture. If you were not in the contract and the rate of exchange would have been this much, you would have lost a massive amount of money. Okay. So this time your fear is that the Canadian dollar, if depreciates or if euro appreciates, things would have been very bad for you. Okay, so this time your risk is in the different direction, and this is what we do in case of the currency forward contract. The theory is explained here in the slides. Okay, I haven't covered this topic fully today. I will discuss something more when we meet next week. Yeah. So, but this is, I won't say introduction, but this is some introduction and some discussion about the nitty-gritty of the currency forwards contract. Currency forward contracts are very old-fashioned, but very basic way of risk management of the companies. And remember, these are the very high value contracts. They're not very small value contracts. So that's everything for today. I made some changes in the spreadsheets